All right, and we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you back here for a special live cast here at the end of 2025. This is the very last day of the year, and we're fortunate to be joined by Lawrence Lepard. Lawrence, how you doing?
I'm great, Adam. Nice to see you again.
Thank you, and I really appreciate you joining me here. I pinged you yesterday, and you were kind enough to say, "Hey, yeah, I'll come on."
Well, I really want to support your show because I think you do great stuff. So,
well, you're super kind, and I'm very happy that you're our last guest of the year here. For the few of you who may be unfamiliar with Lawrence, he is the author of The Big Print: What Happened to America and How Sound Money Will Fix It. We've interviewed Larry before on this channel. You can go back and watch those videos to get Larry's full backstory. But obviously a big proponent of sound money. In Larry's umbrella, that is the precious metals. That also includes Bitcoin. We're going to talk about them all today. And Larry, I guess let's just kick it off with silver, which has been the big story. So, up until a couple of days ago, both gold and silver had vaulted to all-time highs. Silver has had a year of years. It went from, I think, like the high 20s, at the beginning of the year to over 80 in the futures market this past weekend. Now, a lot of people, myself included, to be honest, had been warning folks saying, hey, this is wonderful, but vertical moves don't last. And I think the big question with silver is we've had two previous incidents where silver went vertical, 1980 and then 2011. And after hitting their zenith, silver prices then got just crushed, basically giving up all the gains and then becoming essentially dead money for decades in certain cases. So people were starting to wonder, well, could that happen here? Well, we're in the process really of finding out. So as I said, silver prices, silver future prices crested over 80. They then got whacked down over the past 48 hours, and it's been interesting. So first of all, what ended the previous vertical incidences were largely regulatory maneuvers where the CME went and hiked margins, just basically making it more expensive for people to transact in the metal. And, we saw that certainly in 2011, and it took several different margin hikes before silver broke. We've now had two from the CME in the past week. Will we have more going forward? We'll see. But what happened was silver crested. It dropped pretty dramatically, like 15%. I think it went from like 83 or something like that down to 70. But then it recovered yesterday. It got back, I think, about as high as 78 in the futures market. That's been knocked back down again today, back to 70. This morning, it's crept back up again and is sort of fighting for.
Well, I think spot's actually down a little bit, but it's
I've got a pretty recent futures chart here, and folks, if you can see my cursor. This was the height up at around 83 or so, got whacked down, made it back up to about 78, got whacked back down to about 70. Again, sort of fighting for direction here. But you can see it bottomed recently in the past couple of days, both at 70. So what we kind of have here is silver trying to prove that it's got more resilience this time. And, we're not going to know for another couple of days whether it holds and then rises or whether it breaks and goes down from here. But I'm just curious, Larry, do you have a strong sense one way or the other, whether it's different this time or whether we're likely to see a repeat of what happened?
It's a great question. And I've been, obviously, since I run a fund that focuses on this stuff, I'm all over this topic. I mean, it clearly is somewhat different this time. I mean, in the 1980 example, it was the Hunt brothers trying to corner the market. And the exchange literally changed the rules and said, you are now liquidation only. Nobody can buy. And so that just created it. And that combined with Volcker having rates at a very high level and vowing to fight inflation. Those conditions don't exist today. We were debt to GDP of 30% then, we're doing 20 now.
Right.
And I don't know, they could do something like they did with the Hunts. I mean, an interesting comparable here. Well, let me just start off a big picture. Where am I on silver? It feels a little bit too late to buy, but it may not be. I think you'd be insane to short it here, because what happens with these parabolic moves is how high up is up. I mean, there was a VW, this is clearly a short squeeze to some degree. But it's driven by physical demand, which is legit and has been suppressed for decades, or, by paper. The price has been suppressed by paper for decades. And so, how high up is up? There's the classic short squeeze examples of, VW or Tesla at one time, or more recently GameStop, or even nickel. And, interestingly, in the nickel case, they broke the trades. I mean, they pulled a Hunt brothers on the guy who was right about nickel, and cost a billionaire billions of dollars. And so, a good friend of mine was talking and tweeting, I'm not going to mention his name, on Twitter yesterday about shorting it here. And I sent him a DM and I said, be careful, because this thing could go to 150, 200, we don't know how high up is up.
Yeah.
Now, I'm not suggesting it will necessarily stay there, although it could. I think we are going to reset to a higher level. One thing I feel very strongly about, I don't think we'll see below $50 silver again. I think we're through 50. That was a top for many, many years. And so I feel very comfortable that any kind of checkbacks will find support at 50. And that's just classic technical analysis. You've interviewed Michael Oliver a lot. He's a brilliant technician, and I think is accurate about this. And he thinks it goes to 150, 200. And I try to doubt him. I mean, I actually think it could possibly get there. I think one of the reasons why it's quote unquote a bit different this time is all of the paper silver that has been created over the years. And what's always amazing to me is to just, and it's really hard. Okay, this climate is super hard, because you get on Twitter, you got some people who know what they're talking about silver. You got some people who have no idea what they're talking about. You got all kinds of lies. You got people saying a bank blew up. It's really hard in this world with AI. You got AI guy talking about AI.
You get the AI Asian guy everywhere, right?
Yeah, right. I mean, is that a psyop? Who knows? You got a lot of people talking, and you got a lot of noise. And so you got to be careful to try and figure out what the truth is, where the signal is. But a couple things that I think truly are signal, because they indicate transactions, is we do have physical prices in various places. What true, buyers and sellers are setting a price to deliver metal quickly to one another at. And those prices are strong, they're robust. And in fact, they're in backwardization. They're higher today than the futures price, because people are demanding the metal is tight and people want it now, and they'll pay a premium to get it.
Yep.
There was a thing on Twitter this morning, and I checked it. I went to the site myself. I mean, in Dubai right now, silver is quoted at $95 an ounce US. Okay. That's for immediate settlement. So, 95 is a long way from 72.
Yeah.
So somebody there is, and I don't know how much volume they're doing, or if that's the real price. I mean, it's always a little tough to tell, because, it's like, yeah, filet mignon is cheap. Okay, great. I'll take a ton of it. Well, we don't have any. But the point I guess I'm trying to make is that there's something going on here. And I do think there are some banks and others that are probably on the wrong side of this trade. And I do think that, the exchange, some people say the exchange upping the margins. And by the way, the 30% margin increase, they've only done that one other time before. That's a big increase. And some say, well, they're just protecting the exchange. And that's somewhat true. But it is, as you say, similar to the playbook they used in 2011 to knock the price down, where they jacked the margin rates up quite a bit. The thing to keep in mind, though, on margin rates is it affects both sides. It affects both the longs and the shorts. So, the shorts have got to put up more margin too. And so it tends to affect whoever's the most levered. And arguably the shorts are more levered than the longs. I mean, in many cases, the people who are buying the contracts long actually would be willing to stand for delivery, or they're doing it to hedge it because they have a legitimate business need for the silver in the future. And in fact, that's one of the things that makes this so damn interesting compared to gold or compared to Bitcoin or some of the other monetary substitutes, is that you actually need this stuff.
Right.
We're not using a lot of gold fillings anymore. Gold doesn't go into electronics very often. There's some places it gets used because it can't tarnish, but silver can. But the fact of the matter is the world needs a lot of silver. We mine 800 million ounces a year. We use more than that. We melt down some of the old stuff in scrap. There's a coin dealer near my house where I go, and I see all the old tea sets that the senior citizens bring in when they're running out of money, and they sell their tea set at some fraction of the value of the underlying silver, and he sends it off to a refiner who melts it. And the demand on the solar side and on the battery side, is growing substantially. I've seen numbers that suggest that if solar demand in China continues at the rate that it's now going, China would absorb 60% of the world silver production within a few years, right? And now you've got Toshiba coming out with this solid state battery that uses a lot of silver. And, if you do the projections on that that could absorb a lot of supply in the future. So you've got these things, and there aren't stockpiles of it sitting around. There's a lot of gold sitting around. You set the price high enough and gold will come out of the woodwork. Women will melt down their jewelry. But with silver, there's not a lot of it laying around other than in T sets. And so,
how many T sets are there really left around, right?
Well, I don't know. I chat GPT'd that. There's actually probably a couple billion ounces of T sets and silver junk out there,
candlesticks and stuff like that somewhere. Yeah. But it's not the asset for the past 2 generations. It's not been the asset it was before.
No,
where every house had a silver set.
Yeah. I mean, people have really forgotten about it, and that's the other thing, Adam, I think is going on here, and why this breakout is so violent and has potential to go quite a ways, is that for basically, this is the only commodity that for almost 40 years has not really exceeded its all-time high. It was capped at $50, and so it would trade between, I don't know, as low as 11, in the COVID crisis, briefly, and 50 as a high, and it traded in that range for a long time.
And Larry, let me ask you that. Why do you think that was the case? There's a lot of people out there that say, well, because it was intentionally suppressed, either by big institutions who could make money, slamming it back down and riding it back up, or just sort of the global cabal wanted cheap silver because they needed it for everything from missiles to electronics, and they wanted to keep it artificially low. Do you think it was due more to intervention like that, or do you think it was just a natural mispriced by the market?
It's hard to tell. It might be just natural mispricing by the market. I mean, it's, in sound money terms, it has a much higher stock to flow. And so it's not really that good of money compared to gold, which is why gold is kind of, the gold silver ratio got so high because gold is a much better form of money. I mean, one thing about silver is it's damn big and it's damn bulky. I mean, it, store a lot of value. I mean, you can have a couple $1 million of gold and put it in a briefcase, briefcase, maybe it'll hold $40,000 worth of silver. I mean, I took delivery of 10 Comex bars way back in the day at 1,000 ounces a piece. It bottomed out my cars. I put them in the trunk of my car and it bottomed them out. And, and at the time, I think I paid $5,000. Yeah, I was paying $5 or $6 an ounce at the time. So I paid $5,000 a bar. Well, like 10 bars there's 70 pounds a bar, basically.
Wow.
So that's 700 pounds.
I hope you still have those bars. You must have been buying this back like in the early 2000s?
Just in the 80s. Yeah.
Okay.
80s, 90s. Yeah. I still do. So, and at some price they'll get, they'll enter the supply side of the equation. But yeah, it's a funny metal in that respect. It's got these 2 roles. It's got this monetary role, but it's also got this industrial use role. And the industrial people, they're there and they need it. And people say, well, the price goes high enough, there'll be substitution. I know somebody was talking about maybe copper replacing silver in solar cells. I don't know if that technology is real. I mean, silver is really it's the best conducting metal in the world by far, and it's got a lot of uses. And it's generally a small piece of the value of any particular thing. I think there's probably some silver in your iPhone, but it's probably such a small amount that even if it doubled in price, it wouldn't really move the needle on your iPhone price, right? So, yeah. So it's a funny thing. So where do I think it's going? I don't know. I think we're going higher. I mean, that's my gut is we will see 100, we'll see 125, we'll see 150, maybe we'll see 200. I don't really know. And I don't really know how, these banks and the Comex and all the people who sold all the paper are going to kind of escape from that trap. I mean, I actually kind of worry a little bit about maybe someday there being a zinc-like solution. I mean, the China's declared it a critical metal, and they've said that they're going to have export restrictions, and making it sound like it's going to be zero, but it's not clear. They could still sell some. And the U.S. has declared it a critical metal, and it goes into a lot of defense-related things. And so, there could come some point in time when, we could 6102 it, which, that I'm referring to the grabbing the gold back in the 30s. I mean, if it goes too far too fast, and, you could see a government saying, hey, we're not going to permit this. We're going to cap the price of silver. We're going to buy SLV and cash everybody out in dollars, and take delivery of those ounces. And, this whole thing is solved. I mean, that kind of thing is a possibility, which is why, I've always advocated actually holding the metal versus having any kind of paper claim on the metal, which is what an ETF is.
Right, right. And just to be super clear, I don't think you suspect the government will confiscate silver from households, but it would go like Willie Sutton, why do you rob the banks? Well, that's where the money is. It will go where the silver is, which is the massive ETFs, and just say, exactly. Hey, we're nationalizing them.
Exactly. So we're nationalizing these ETFs, and we're going to pay you the cash on the barrelhead, whatever the last trade was. We'll pay it. Right. The next day, the opening trade would be much higher. And those of us who have coins and bars would be thinking, "Oh, that's nice. Our stuff's going up." And if you had the SLV, now you've got a piece of cash. So,
yeah.
I don't know. I mean, it's interesting. I don't want. I mean, not her, Adam. I don't want to speculate on anything because you just don't really know. But I do have a very strong, based on 30 years in this business, watching it, listening to all this, knowing how the other side operates. I have an extremely strong suspicion that somebody's in trouble on the short side, and that this is going to get squeezed much higher, and that shorting it here would be suicidal. Going long it here, I think probably works for a while, but you might have to be nimble. I mean, it could run up to 200 and correct back to 100, right? I just don't know.
Yeah. So you mentioned a number of things that are kind of different this time. One you just briefly mentioned is the China export ban,
right?
Which goes into effect, I think, in a matter of days,
right?
And we'll see how that's actually going to play out. But China basically refines the vast majority of the world's silver, and has basically said, well, silver's going to come into us still, but it's not going to leave our borders anymore. And so that could be a real potential game changer here. At the same time, we are seeing real tightness in the physical flows of silver. We've seen a real draining of the LBMA, the main sort of London clearinghouse for silver. A lot of that's gone to the COMEX here in the US, and a lot of that COMEX inventory on a relative basis has been stood for delivery. So normally futures contracts settle in cash, but more and more players are now saying, you know what, nope, I'm just going to take the silver at the end of the contract. And it's happening at such levels, and I'm really parroting Andy Schechtman, who I interview, who tracks this stuff much more than I do.
Yeah, he's great.
Who is saying, we're seeing record, tonnage flows of silver out of the major exchanges like the COMEX. And so it shows that A, people are scrambling for physical. B, the size of some of these deliveries, he's scratching his head and saying, I'm having trouble figuring out who could stand for that much delivery unless it's like a sovereign entity. And in some ways, he thinks that governments are starting to really stockpile, sort of as quietly as they can here. We're also seeing other big players. Now, I've predicted this for a long time, and I think we're finally starting to see it, which is, hey, if you've got a critical element like this for industry, and you're a big player, like an electronics manufacturer, you're going to want to lock up supply. I mean, why don't you end up just going out and buying some mines and stuff like that? And we're starting to see that with different players out there.
Silver Storm just sold their future production to Samsung for exactly that, in that kind of a transaction. And another miner that I know down in Peru, Koya, was approached by a Chinese group to pay $80 an ounce to lock up future production. And obviously that group thinks that 80 will be a bargain in a few years, and they probably are right.
Yeah.
Back to your China point, I mean, China's accounting for about 113,000 ounces of production a year, or roughly that. And, they're 800 million ounces of production. So, that's a non-trivial. You take that supply off of the world market and they use it internally. Okay, that's interesting. Now, of course, some of that also is the supply that just helps their solar. So it's not quite, the China ban necessarily isn't quite as much of a tightener as is portrayed as being. But I think Andy's point is really valid, though. I mean, you do see people taking delivery, and this is the thing that really always blows my mind is because you can see the volumes, right? We produce 800 million ounces a day, or I'm sorry, 800 million ounces of silver a year. Yeah, which really isn't that big a number in the total scheme of financial assets. I mean, it's $80 billion something. There are days on the COMEX, where they trade that amount in the morning.
Yeah.
You know what I mean? They're trading. I mean, and this is what tells you that how big the paper market is, and how, they're just claims. I mean, that's just somebody saying, I've got silver, I'll sell to you. They don't. And somebody else saying, great, I'll buy that silver from you and paying a price for it. And, it's all fun and games until, until
people want the metal,
until somebody says deliver. and this is the reason you can tell that it's broken is that the difference between spot and between physical and futures and the spot price. And what you're seeing is people are paying more. The prices aren't real anymore that they're quoting on a spot basis. It's not real for delivery. It's like, yes, it's that price. Okay, give me some. Well, sorry, we don't have it.
Right.
If you really want to get it delivered, you got to go to Dubai and pay $95 an ounce when it's at 72 right here. So how does that work, right? I mean, so this is a big issue. And I tweeted about it, and a lot of people gave me shit and thought I was being extremist. But I just said, wouldn't it be ironic if silver were the Lehman moment of this particular cycle? And they've created this incredible derivative structure of leverage on leverage on leverage. They're trading, 3 times the annual production in a given day. And suddenly, a number of big parties become aware of this. I mean, as I've always said this, and Andy said it too, it would only take a few billionaires to go, hey, you know what?
I've said this too.
Right?
Yeah. But I think that's the real difference here between the 1980 with the Hunts, right? The Hunts was a calculated, vulnerability in the market that a single party said, I'm going to try to take short-term advantage of this and squeeze everybody and get my pop and profit, right?
Right.
Here you've got numerous big players,
correct,
sovereigns, big corporates, banks that are playing this on the paper. I mean, there's just so many parties here that are, at this point now saying, you know what, I've got a preference for the actual physical stuff that's scarce. That there's no one person to kind of push out the way they were.
Right. It also dovetails nicely with the sound money thesis, and you're now starting to see retail get involved, and that's always how this works. Gold goes first, and then silver follows. And the average citizen, 1 ounce of gold is $4,000. I mean, in a country where a lot of people can't come up with 400, they're not going to go buy an ounce of gold, but they can buy an ounce of silver for 70 or 80.
Right.
And they're going to do it. And
yeah, but it doesn't seem like we're there yet. I mean, that's one of the other reasons
why
I'm getting mixed. Your caution about going short. Yeah.
Yeah, I'm getting mixed reactions. I mean, Brian Kuzmar and some other good guys online are, and some pictures of, excuse me, of people in Australia queuing up to buy silver. I mean, I think retail's starting to get interested. I mean, you see the Google searches on how do I buy silver. Those have gone up a lot. So
I guess so. Well, here's a question. Like,
right?
You remember back in 2011? Yeah. When things were raging and gold was, going to whatever it was back then, 800 or whatever, or 1900. Cash for gold ads were everywhere.
Yes.
Do you think we'll see cash for silver ads before this is over?
Maybe. Yeah, maybe it would make sense, right? It would totally make sense.
I've not seen one though. No. I haven't even seen cash for gold ads.
Well, and this goes. This is my last quarterly report. I mean, nobody owns this stuff, and that's the whole thing. I mean, a lot of people look at the chart and they see a parabolic line and they go, "Oh my God, this is a no-brainer. I short this," right? And there's some sense to that. I mean, generally parabolas don't last. But what's nonsensical about that is how high does it go? Right. Are we in inning 1 or are we in inning 7? You know what I mean? We just don't know. And so I wouldn't short it. All right. But I'm not here to guarantee it's going to 200 either, right?
Yeah, no, I know, but we're at a tricky part, right? Where for all your professional instincts, you don't think the run is done yet, but it's probably going to get a lot more volatile here.
Well, right? That's for sure. Yeah, that's for sure. I mean, we've already seen that with the increase in margins and so on and so forth. But as I say, I feel like 50 is a pretty good base. I mean, if I saw it back at 50, I'd probably be a buyer.
Which is crazy because just a couple of months ago, we'd sold our right arms for silver, right?
Yeah,
or for 50.
Right. I mean. The beginning of the year was 28. I mean, so yeah, it's a very interesting metal and it's a very interesting time. And back to my thesis that it could be the linchpin for the whole thing coming unglued. I mean, if some GSIBs, some globally, systematically important banks are short this, as some have rumored and some have said, and there's some fake stuff on Twitter about this as well. But if some big parties are short and are caught on the wrong side of this trade, and their failure would be a threat to the financial system, well, that could be a trigger event. And the other thing is, I think it highlights just the the fiat paper games that are being played in kind of everything, and and the leverage that's being employed kind of everywhere. And so, when I mean, how these things are, it's like cockroaches. One of them comes out, there are going to be more. So,
well, let me just repeat one thing that Andy's mentioned on this. Which is, forever the big U.S. banks have been net short silver, like J.P. Morgan, right? People have vilified it, probably, correctly for many reasons, because it had a chronic big net short position and seemed to always make out by engineering these silver slams, and even getting, caught and having to pay fines for doing so, but they were, tiny amounts for what they were making. He says, for whatever data he looks at, that the U.S. banks, J.P. Morgan in particular, are now net long. And so he thinks that's a game changer in the sense that a lot of that pressure that was keeping silver suppressed on the paper side by these big players is now going the other direction. And he says that he believes the shorts are still, the folks who are still short are the European banks. And that's where the pain's going to be felt most here.
I've seen that. I've read that, and I think that's very possibly true. I'm pretty sure that Morgan was smart enough. J.P. Morgan. It's really hard to know who owns what. This isn't all fully disclosed, and we're all kind of looking at the tea leaves and just making some educated guesses here. Okay, yeah. So let's be clear about that. But I've heard, we've heard, and there does seem to be a lot of evidence that would suggest that J.P. Morgan was net short and at least got flat, and maybe arguably they're probably net long today. Not so clear with the others. I mean, Bank of America, they're not the brightest bunch, and Citigroup, same story. And so it's not 100% clear to me that they're not somewhat net short today. But I agree, the European banks, UBS in particular, would suggest, I think are somewhat possibly short. And, again, the market is so opaque, it's difficult to tell. But the prices are, the one thing we can rely on. We can see them; they're reported, and they are the signal that to watch. And we're in a bull market, and my sense is it's got quite a ways to run.
Okay. Well, in terms of ways to play, proceed with caution. Obviously, as Andy's saying here, I just want to remind folks again, get it back to Andy Checkman, because his firm, Miles Franklin, is Thoughtful Money's endorsed precious metals provider. And once silver cracked through $60 an ounce, I'd reached out to him and said, hey, is there anything that we can do for the Thoughtful Money audience, kind of in celebration of this big milestone? And he said, yeah, I will give you guys the ability to buy junk silver for $1 under spot for as long as my supplies last. And a ton of people have taken him up on this offer through here. He still has supply, won't last forever. If you're interested in that, just fill out the really short form here at thoughtfulmoney.com/buygold. And it's really one of the absolute cheapest ways to buy silver right now. And if Larry's instincts are correct and that there's still more room to run here, this may be actually a pretty good opportunity to buy in now that prices have corrected, 15% from where they were on Sunday. But, caveat emptor, as Larry and I have been saying here, things are likely to be pretty volatile from here. Now, this is not personal financial advice, but because, as I said, Larry, I've been warning people that vertical moves don't last forever.
Yeah.
I've got a fair amount of ounces that I own, and I don't want to sell those ounces. But I also don't just want to ride, if this thing corrects, down to 50 or whatever, or worse, I don't want to just ride 100% of that, eat 100% of that correction if I don't have to. And so what I've chosen to do is to hedge my portfolio. And last week I did end up putting on a new hedge, which is now nicely in the green. I got to determine if I want to sell it or not at this point in time. Yeah. But there are ways to use things like you could use an inverse ETF. You could use I used put options on SLB. And so, folks, if you don't have, there are ways to give yourself some insurance, even if you don't want to sell your physical ounces. If you don't know how to do this, if you don't feel comfortable doing it on your own, then talk to a good financial advisor who understands how to do this. Obviously, if you don't have one of your own to talk to, you can talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me here on this channel every week. And to do that, you can just fill out the short form at thoughtfulmoney.com. and talk to those guys for free. They'll happily tell you learn about your personal situation and tell you what hedging techniques they think might make sense for you. So, all right, that's pretty much it for silver. Unless there's anything else you want to say about silver, Larry.
No, I mean, I think it's going to be interesting. Grab the popcorn.
Okay.
The first quarter is going to be very, very interesting because somebody's caught, in my estimation.
Okay, so we got 15 minutes left and 3 topics. I want to see if we can power through each of which we could talk for an hour on. So let's do a little bit of lightning round here. So let's just go to gold real quick. So gold is still hanging in there. It's at a little under 4,400 right now, I think, in the futures market. That's still a fantastic price for gold. Where do you see gold going in the coming year? Do you see it continuing to power higher or taking?
I definitely think it's going to power higher, and it has not been a parabolic move. It's been a strong move. And gold to me just reflects the loss of faith in fiat currencies and what happened post, our grabbing the Russian assets. And so, I sincerely believe we are in a, secular bear market for fiat and a secular bull market for real things, including gold, silver, real estate, Bitcoin. Well, Bitcoin's a synthetic thing, but it's real in terms of the algorithm being limiting its supply. And therefore, my sense is that gold goes higher. I mean, I put it at 5,000 or 6,000, maybe the end of next year, and I don't think a $10,000 or $20,000 target is out of the question. If you look at historical bull markets in gold, what they've done from the bottom to the top. I mean, if we call the bottom, you can call the bottom either $1,000 back in 2015, or you can call it a more recent bottom, kind of the 2,000, 3,000 area. To my view, we're still in the second or third inning here. So I'm quite bullish on gold. It's interesting too. And then this is, tooting my own horn, Adam. I mean, I'm really bullish on the miners. I mean, the miners are up a lot this year, but not as much as they should be, given how much the metals have moved, particularly so.
Yeah. What's the why behind that, do you think?
Well, I think it's a tough business. And the miners annihilated a generation of investors between 2011 and 2015, and I was one of them. It was damn awful. And as a result of that, there's I call it the battered gold bull syndrome, battered gold stock bull syndrome. And it was just so awful and so ugly. And the businesses are such a tough business that, in spite of the fact that the metal is going crazy and the margins are 60% plus, we're still looking at companies trading at 5 to 7x cash flow when, the big triple Q companies all trade at 50 times or 20 to 50 times cash flow. And, they're both making cash, and a business is a function of its future cash flows. And so, now some of those triple Q companies are monopolies, and so they're probably more defensible than some of the miners are, in the sense that, this is a commodity. But they really, in my view, we're still kind of in the third inning for the mining shares. And although my fund is up a lot this year, I think we'll have a pretty good year next year too. And I think one way, if you feel late to buying the actual metals and you're willing, to size it appropriately so you can handle the volatility, I still think just buying the mining ETFs is not a bad idea. And then more specifically, I pick companies within those because I think, some companies are better than others. But
right, the ETFs have a lot of. I mean, there's a lot of dogs in the mining.
Yeah, they almost they're weighted average. They're based on the weight and the valuations, and some of them are incorrect. So
yeah. Okay, and I lied. I remember there was one other topic. So we're still going on our lightning round.
I can go a little over 45 minutes too. Not a lot, but a little.
That's okay. Okay, so Bitcoin.
Yeah.
That is something that falls under the umbrella, as you've said, of what you consider to be sound money. Bitcoin has not had as good of a year as the precious metals. Now
it's been dreadful.
It had phenomenal years getting up to here. So, Bitcoin, longtime Bitcoin holders are still doing just fine. What are your thoughts about Bitcoin going forward from here? Has it peaked, or is it just consolidating?
No. Bitcoin, I wrote a book about it. I'm a strong believer in Bitcoin. Bitcoin, in my view, is digital gold. Digital gold will ultimately catch up with and surpass analog gold. But as I've always told all my Bitcoin friends, guys, this is a process and it takes years and decades. I mean, gold's got a 5,000-year head start. And the average person, when they think inflation protection, they think gold and silver. They don't think Bitcoin. They don't even know what it is. And like so many people, like the guy I was just at the gym with this morning, he said to me, well, yeah, I was going to buy it, but Trump coin came out, and I think all that stuff's bullshit. And he's right. Trump coin is bullshit, but Bitcoin's not. Bitcoin's an algorithm, and it's a protocol that's going to, in my view, continue to grow. So on a relative basis right now, if you look at the Bitcoin gold chart, Bitcoin is a screaming buy in gold terms. And some people, the gold people say, well, therefore, and Peter Schiff and others say, yeah, in fact, it's a screaming buy because it's going to go to zero. And I just don't believe that. I think Bitcoin is going to be just fine. And it's so funny to me, Adam, because this kind of reminds me back in 2023 when Bitcoin was soaring and gold was doing poorly. Everyone thought, oh, this is new digital gold, and gold and silver are dead and they're never going to live, and those miners, they suck, and blah, blah, blah. And Bitcoin was the bright, shiny thing, right? And right now, and nobody wanted any gold and silver, of course, and I hung in there managing my fund, believing they would ultimately work. And right now, gold and silver are bright, shiny things, and they're working great. And everybody who's in them is growing, and I get it. I'm in them too, and I'm happy that they're working. And Bitcoin's kind of a dog, and people are blaming Saylor and MicroStrategy, and to me, it's just a screaming opportunity. I mean, I look at MicroStrategy today. That stock's a 10-bagger in the next 5 years, in my view. And I'll be buying it, with silver and gold proceeds here next year. So, well,
that was a question I was going to get to. Are you shifting any gold into
Bitcoin? I am at the margin. Yeah, at the margin. I mean, I think I made it pretty clear what my weightings were. I think coming into this year, I was about 70% Bitcoin, 30% gold. Well, guess what happens when all the gold stuff doubles in value? Because that was gold stocks, and my fund is up 150% year to date, 148 through November, and I think we're up 10% this month. So, we're going to be up 150, 160% this year. And so,
congratulations.
Thank you. I mean, it's not that much better than the averages, by the way, which is a little frustrating to me, but full disclosure. But the point is that, you take that, you do that in 70-30 Bitcoin gold, you hold the Bitcoin flat, you double the value of the gold. Well, now I'm probably 60-40 gold Bitcoin. And, so I will be lightening up on some of those gold stocks, not selling them all, not dumping gold. But I mean, this is, to my way of seeing it, this is what a professional investor does. You try to buy what's cheap and out of favor, and you try to sell the things that are screaming. And, I think they're going to keep screaming, but I also think that on a relative basis, Bitcoin and MicroStrategy are probably better bets right here, even though they don't feel that way. And, your show talks about this a lot. I mean, sometimes in investing, what feels uncomfortable is what's right. And what feels comfortable and obvious actually turns out to be wrong. And right now, it might feel really comfortable and obvious to be in silver and gold mining stocks. And, I think we've got another good year or so here for sure, but I don't think Bitcoin's dead, and I think it's relatively cheap. And keep in mind that the underlying theme of the book and of what you're talking about, what I'm talking about is, there's, call it $900 trillion of financial assets out there. Gold, stock, bonds, everything, all including real estate. So actually, there's 450 if you just do the financial, take the real estate out. Well, the total Bitcoin marketplace is 1.8 trillion and the total gold marketplace is 30, but really only about half that gold's available for sale because all the rest is either in jewelry or in a museum. And so it's really about a $15 trillion market. Bitcoin, call it a $2 trillion market. That's 17 out of 450. And that 450 is growing, and it's probably about to grow a lot more rapidly because the Fed just started the pivot, which is what is my friend Lynn calls the gradual print. And she's right. It's gradual so far.
Gradual print.
But I think it's going to morph into the big print. And I wrote a book about it, obviously. And, I because mathematically it has to. And so I think as it does morph into the big print, all these sound money alternatives, real estate, gold, silver, Bitcoin, they're all going to go higher. In fiat terms, the negative is, of course, be careful what you wish for, because so is the price of hamburger and so is the price of gasoline.
Right. Right. It's a sign of the currency dying.
The currency is under attack.
All right. So let me get to the big question that we've now taken 40 minutes to build up to here. So I have to name these live streams before I know for sure what we're going to talk about. Yeah. And I named this one, Is Cash Now Trash? And I think in one hand, I'm hearing you say, Larry, yeah, kind of, because of all the whole thesis of your book, The Big Print. but we've got the precious metals in a bull market. We've got Bitcoin. You believe in a bull market. You think they're going to appreciate nominally, versus cash next year. The Fed, as you just mentioned, is now officially, back to easing. We're cutting rates. It doesn't want to call it QE, but it's now doing QE. So you can definitely make the argument, hey, you want to exchange your cash for hard assets next year. At the same time, the precious metals have rushed into what clearly last week was overbought territory. It's going to be more volatile going forward, as you said. And even stocks, which do benefit from the big print, they're trading at valuations that are often, in many cases, at record extremes. We've never seen them. So as you look to 2026, do you think cash will be trash next year, or could it be a rare year where it actually appreciates versus?
Yeah, not necessarily. And it's funny you should bring this up and I tweeted about this a while back because people gave me some shit for it. But for the first time in my life, I actually am kind of feeling like I want to actually hold a little bit of cash too. And I'll tell you why. I mean, one of the world's smartest investors, Warren Buffett, has built up a big, stash of cash. The stock market, to me, looks like an accident waiting to happen, but I'm not going to call the top because I've tried that for 10 years. I've been dead ass wrong. I've lost a lot of money, on put options. We live in a very uncertain world. And I do feel like there's some point, and the AI thing, look, it is changing the world. It's great technology. It's like the internet. It's going to change all our lives. Okay, fine. But it strikes me as being ahead of itself. You were around it. I know you were at Yahoo in the early days in 2008. I mean, or 2000.
Not early enough, but early.
Yeah, right. I mean, I have a real deja vu with the .com bubble here and AI. And so, I mean, cash is very valuable. In 1929, cash was really valuable because the price of everything was about to fall 90%. And so, you could then come in in 1931 or 32 and scoop up, good quality companies at 10% of their prior value.
The Rothschild, blood in the streets. Yeah,
exactly. And so, with that, and by the way, I think that's one of the greatest risks to all investors. I think all investors are kind of sleepwalking into this, that to get my big print, we probably need something to break. I mean, we've had two big prints already. I'm predicting a third one. The first big one was 2008. The second big one was COVID. And in both cases, there was a trigger, right? In 2008, it was the housing bubble. And in COVID, it was COVID, right? And so, it's possible that we're going to need, for the truly big print that I foresee, where the Fed grows its balance sheet, not, this 30 to 50,000, 40 billion a month, but I'm talking, trillions, right?
Right. You're going to need some systemic pain before that gets over.
Something breaking big, something failing, problems, etc. Kind of a panic. And when you get those, guess what? Everything goes down in fiat terms, just by definition, because everyone's so levered, and everyone scrambles for cash. And when they do, cash becomes king. And so, and of course, we know the reason I wrote the book, the reason I believe that condition probably won't last very long, is that we've seen their playbook, and we know that their third mandate is financial stability.
Yeah.
And so
we know the reaction function.
Exactly. We know that. But I mean, I got to tell you, I'll give you a perfect, personal example. That silver that I owned, I actually had it at a depository. I borrowed against it in 2020. And one morning in March of 2020, I got a call, and the guy said, if you don't have X $1,000 to me within 24 hours, I'm going to force liquidate your silver at $11. And it had been 19 3 days earlier. And I had the money, and I got it somewhere else, and I met the margin call, and I didn't get forced liquidated, thank goodness, because I didn't want to sell my silver at $11. But the point is that leverage, we're in a very uncertain fourth turning. So leverage is not your friend. I've always said that. I strongly believe that. I've seen so many people in Bitcoin everywhere, just they're so convinced they've got it right, and none of us really know. It goes back to that old Wall Street saying, I mean, nobody knows nothing. And there's a certain element of truth to that. You just can't predict. It's all probabilities. And, something could break, and we could see all these prices fall 50%. And, woe be to the person who's highly leveraged and has to sell a good asset in that kind of a panic condition. And the flip of that is, I wish I'd been sitting on a bunch of cash in March of 2020. And silver went from 20 to 11, and I probably would have pounced on it. right?
Mhm.
But I didn't have the cash. I was on the other condition. I was levered up. So, it's just that's the argument for, taking a longer view of this. And
Okay. So longer view for you, cash is trash, but shorter view,
shorter view, having
may have
5%
some utility.
might make a lot of sense. And not being leveraged, I think, is a really important lesson. Particularly I see young people making the mistake a lot. They want to get there faster. And they're like, okay, well, I'm sure I'm right about this. I'm going to lever it up. Well, okay, be careful.
Mhm. All right. Well, look, Larry, I'm very sensitive to the fact that you told me that you had a hard stop at 8:45. We're pretty much there. I'll
Okay.
leave it to you. If you need to go now, we'll wrap it up.
We can go another 5 if you have like one more question. But after that, I do got to go because I got to be
Well, so
12 and I got to drive to get there. But I got a few minutes.
Okay. Before we turn the camera on, we were opining about the recent developments in Minnesota, is indicative of a greater sense of fraud, waste, and abuse that's clearly going on in lots of places across this country. I really just wanted to give you a chance to react in any way publicly to that.
That video, just the Nick Shirley video, it just shocked me. I mean, I was just like, what are we doing here? Do you know what I mean? And it's not to say there's not corruption on both sides. This isn't a blue-red thing. This is just how have we lost our way so badly that we can obviously have taxpayers getting scammed in such a way, and that I mean, where's the mainstream media in reporting on this? I mean, to the degree I've been able to look at the mainstream media talking about him, they're accusing him of being some kind of a Trump agent, taking swipe, they're trying to make it a partisan issue. It's not a partisan issue. The guy drove around and found out there are a bunch of fake healthcare centers that are ripping off the government and not educating, not providing, or not healthcare, I'm sorry, learning centers, and not providing any learning or any daycare. And it's just like, this is pretty simple, right?
I think the depressing part is that it's not just the people that are taking advantage of the system. It's that so many people are making money in that, and a lot of those players, we may be increasingly finding out, are in the state that they're turning a blind eye to this, and that the media is potentially complicit in this and not reporting. In fact, I talked about this last night on X in some depth, and there are a couple of people there from Minnesota saying like, yeah, we're not hearing anything on our local news about this, which is bananas.
Yeah, I mean, you got 60 million people watching this video. I mean, that's an enormous number. Right?
I think it's like 130 million now.
Oh, is it really? Okay, whatever. Yeah. I mean, it's there are 8 billion people in the world, so yeah, I don't know how many of them are Americans, but the point is, yeah, I mean, it's almost like we live in two alternative realities. We've got the reality that those of us who are, getting our news, from the web and independent sources observe, and then we've got the reality that the people who are still brainwashed observe, and they're just two completely different realities. It's amazing to me. I don't know how we bridge this gap or how we fix these problems, but boy, we sure have to, because this is no way to run a railroad, right?
No. So a couple of things, and I want to tie this actually to your book, the theme of your book. So I was at dinner last night with actually a very successful fund manager, and we were talking about this, and we basically kind of did some back of the envelope math and said, what, if we could get rid of the waste, fraud, and abuse that's going on with public funds, we probably wouldn't have a deficit.
I can see that. I mean, I think, and this is, and by the way, I watched this very carefully because I've made a big bet on this monetary debasement theme, which, it's Lynn Alden's view of kind of nothing stops this train. Of course, that was one of the chapters of my book, which I borrowed from her. And, but it doesn't have to be that way, Adam. I mean, it does not have to be that way. I mean, I've spoken with David Stockman about the defense budget. I mean, if we had somebody who was really smart and honest and had the ability to drain the swamp, you could go at the government and balance this budget. You just could. I mean, it's done. It's doable. Not easily. And maybe we need lower interest rates to do it, and we probably need entitlement reforms as well. But it could be done, and if it is done, then you save the dollar. But I think what somebody also said that Elon Musk is a smart man because he got in there with Doge, and in 2 or 3 months he figured it out and said, oh, fuck that, pardon me, F this. This is impossible. I'm not gonna, you can't do it. I mean, the system just won't let you do it. Right?
Well, and he just tweeted yesterday, he said, look, as enraged as you all are by this fraud that's being uncovered by the citizen journalism here, he's like, I will bet, my reputation that the fraud that's just in like Social Security and Medicare dwarfs everything that you're enraged by right now.
Yeah, right. Well, and then look at the defense contractors and the the $500 toilet seats. I mean, look, we've seen this. I mean, the Pentagon can't account for billions of dollars spent. I mean, we've kind of got this behemoth, and this is what this fourth turning is all about. We've got to reform this government. We've just got to. We've got to. This is not what our forebears signed up for or designed. It's fallen off the rails, and we need a serious reform. And sadly, it seems to me like it might be the monetary sphere and a lot of pain in the monetary sphere that leads to that reform. But I hope that's not the case. I mean, I would like to think that an educated group of smart people, maybe a really honest centrist candidate could rise above this blue-red bullshit and get in here and say, look, here's how we do it. And it's not that hard, folks.
Yeah. Well,
I don't see that. Right.
You get what you demand, and we haven't been demanding it, as a populace at the voting booth. Will we? Who knows? I'm kind of crossing my fingers and hoping that Doge has infected the system and it starts just going, through our.
Me too. I'm not a pessimist. I believe in America. I believe in the dream. I think we can fix it, but it's a question mark right now, and we've got work to do. A lot of work to do.
Yeah. Well, just to tie to your book so we can let you go.
Yeah.
To your point about, the media being so silent on all this, a lot of people, I think right up until Nick Shirley's video kind of put it in front of everyone's faces, when you brought this stuff up, they'd be like, it can't be that bad.
Right.
Like, we'd have heard about it, right? You can't hide something like this, right? Well, the answer is kind of, no, you actually really can. And it's the same thing around monetary debasement for the average person, right? The people that are watching this channel are the people who are, awake and aware and have been doing the research on, how the monetary system runs. The average person doesn't know any of this stuff. And they just think, look, if it were that bad, if they were killing the value of our car, like we would know. They couldn't put a limit. And the answer is like, no, they can. And they have been for decades. And so you need to be doing your own education so that you can be out ahead of this and just not steamrolled as
well. That's why with every print, more people wake up, and with every Nick Shirley video, more people wake up. And COVID was another one, right? And so, yeah, I mean, when it gets in, it gets in your face enough. I mean, pretty soon you kind of get to, who are you going to believe, me or your lying eyes?
Yeah.
And I mean, to me, I actually think this Shirley video is a seminal moment. I really do. I think it'll go down in history as a moment where, compare it to, Kennedy being assassinated and any big, event, Nixon going off the gold standard, where it'll just shift the views of the populace a lot.
Yeah. Well, same thing when that book got released, The Big Print. It just woke up the populace to what was going on.
Yeah, all 50,000 people who bought it. It's a drop of water in a big bucket.
No, it's definitely an important.
I appreciate that. I hope it gets legs and becomes kind of fourth turning like and builds over time. I mean, that book started off very slow, and we're still quoting it here 20 years later. And so I'm kind of hoping that happens here. I have seen it turn into a meme. I mean, more and more people are using, just like Lynn's train. People are now saying, "Well, the big print's coming." So that's nice.
Well, it's a great title. So for folks that would be interested in getting the book, where can they get it?
Oh, yeah, it's on Amazon. It's interesting. I mean, this is another example, Adam, of how the system works. I've submitted to all the mainstream publishers. No one will touch it. It's an edgy book. I'm an edgy guy. I have a view that's anti-establishment and anti-government system. And so, they're not going to print this book. And so I thank God for Amazon. I self-published. It's available on Amazon. You can get it hardcover, paperback, Kindle, and audio. And, just pass it on, pass it to your friends. And it's, you could argue that it's monetarily subversive, but I think in a good way, because I think if we return to sound money, the world will get better. And I'm very optimistic that we ultimately will return to sound money. It's kind of have to, because as it is right now, it's broken. And to me, the evidence that it's broken is just look at the, go to the grocery store, right? I mean, it's just every day, it's, a lot of people are hurting because things are very expensive.
Well, as you say, Larry, it's simplistic, but there's a lot of truth in it, which is right. Fix the money, fix the world, right?
Yeah, exactly. I borrowed that from Marty Bent.
Well, so besides buying the book, Larry, if folks want to follow you and your work, is there any?
Yeah, I'm on Twitter, just under my name, Lawrence Lepard. My website is ema2.com. It's a fund we manage. There are macro letters on there. They're free. Every quarter, we write a letter that talks about all these things I just discussed. You can get them. You can sign up for them by putting your email into the site, and then we mail it out every time we write one. We will never spam you. Only 4 times a year we write that letter. So, yeah, that's really it. And then I occasionally go to trade shows, so I'm trying to cut that back. But
all right.
Well, but anyway, Adam, I really appreciate
the ones I go to.
So I think you're doing a great job, a great service to people, and it's an honor to be with you. So it's going to be fun. Get your popcorn on the silver market. We'll see what happens.
All right. Well, Larry, we'll have you back on early in Q1 to give us an audible update as to where things go. Thanks so much for being our final guest of 2025.
Oh, boy.
Very much appreciate it. Have yourself a wonderful New Year's.
Yeah, you too.
All right. And folks, do me a favor, just hit that like button to thank Larry for coming on here, and let him know in the comment section below, too, how much you appreciate him. Larry, again, can't thank you enough, buddy.
Oh, thanks, Adam. Good to see you.
All right. Everybody else, thanks so much for watching, and Happy New Year.
I think a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell. Maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing. It's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%.
Silver is up 42% this year, outpacing gold and marking its strongest 5-year rally, fueled by industrial demand from solar, EVs, and electronics. HSBC raised its outlook, citing a growing supply deficit of 206 ounces in 2025. Analysts agree silver remains undervalued despite big gains, with momentum pointing to $44 to $48 by year-end. Mining stocks, especially juniors, are already outperforming, offering leveraged upside as investors rotate into the sector. David Morgan, widely known as the Silver Guru, is a seasoned precious metals analyst, author, and founder of the Morgan Report. He points out that silver's momentum is building thanks to institutional buying, industrial demand, and algorithm-driven trading that continues to push prices higher. Despite heavy short positions, the trend has turned positive, with momentum indicators signaling strength. Gold has already broken out, while silver, being a smaller market, tends to move more sharply once momentum takes hold. Historically, miners often led metals higher, but this cycle has been different. Metals surged first while miners lagged. Now, strong earnings and value recognition are finally fueling a rally in gold stocks. Silver stocks remain trickier since most companies are not pure silver plays, often producing other metals alongside it. Still, silver miners can command higher premiums in bull markets because of silver's volatility and popularity at the top. David recommends that traditional valuation metrics like PE aren't the best for miners, as free cash flow and balance sheet strength matter more. According to the Morgan Report, well-positioned mining equities, starting with blue-chip producers and selectively adding speculative plays, offer some of the best leverage in the resource sector, especially as demand for metals like copper, lithium, and rare earths accelerates. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
As I've said before, and it sounds trite, but it is true, and that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is. But we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum. And momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts. It's I've been in this market more than 40 years, and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip-off for somebody that's, studied these markets. Like, these gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated, a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies because many of these companies are trading as if gold is at 2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And wherever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays. If any, there's really one silver stock I can think of that's more or less pure silver play. The rest are silver plays, but they have, lead or zinc or copper or gold or something, combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but an equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
I'm not finding it in the comps table. I was curious where we're at in terms of valuations for the major miners, but also some of the smaller producers. Like, where do you think we're at right now? Do you have an overview?
I don't. I know we're below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper, I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk to reward profile.
David mentions that in Elliott wave theory, the third wave is usually the strongest and most dynamic, marked by the sharpest price gains in the shortest time with heavy trading volume. This stage reflects a major shift in psychology, moving from disbelief to broad recognition as more participants enter the market. Currently, silver seems to be in the early part of this leg, with institutional and industrial demand driving momentum while retail investors remain hesitant, especially those who only recently broke even. Asian markets are also playing a larger role than before, though retail silver buying there still lags behind gold. Looking ahead, this leg could bring the most powerful price appreciation yet, potentially lasting several more years. While past rallies, like the false start in 2016, failed to sustain momentum, the current setup appears stronger, supported by gold's breakout well above $2,000 and holding near $3,500. David predicts that the coming days will confirm whether this is a genuine breakout or another fake-out, but the fundamentals and market psychology suggest silver could now be entering its most explosive phase. Let's move into the interview.
That wave 3 up, there's 5 waves in Elliott, is usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. It's driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. But institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But the facts are backing me up now. There was a false start, I believe, in 2016. I can, talk about that. I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2,000 breakout level. It's $1,300, $1,400, $1,500 above that. Almost not quite a double, but from 2,000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times.
Silver appears to be entering a decisive stage where strong momentum, institutional demand, and shifting market psychology could fuel its most powerful rally in decades. With gold already sustaining record highs and miners beginning to catch up, silver's smaller market size and volatility suggest sharp moves ahead. Whether this proves to be the beginning of a lasting breakout or another temporary surge, the conditions look stronger than they have in years. Do you think silver can outperform gold in the next phase of this bull market? Will retail investors return in time to catch the biggest gains, or will institutions dominate this rally? We would be glad to hear your opinions, so please leave them in the comments area below. If you found this video useful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.
We are at the end of a major monetary era, and this one is so big that it's going to end, sadly, a catastrophe for the world. This is why we went into gold investments for ourselves and for our clients at the beginning of this century, and we never changed our mind, and we're, as you know, only in physical gold and helping people around the world.
The way that Modi, who had been playing a two-step dance with Trump and with Russia and China, has now gone into a quick step right into the hands of Putin and Xi.
But isn't that telling us that, this is the end for the West, the end for the United States? Obviously, the EU will follow also.
What will emerge is that China is going to stand firm on tariff and trade issues.
We are at the end of a major monetary era that will end in global catastrophe, which is why they've stayed invested only in physical gold since the early 2000s. At the recent SCO summit, warmer ties between Modi, Xi, and Putin signaled India's shift toward balancing U.S. pressure, especially after friction over Russian oil tariffs. Analysts warn that U.S. deficits, trade wars, and eroding trust in the dollar could make capital controls increasingly plausible, with scope even warning of a potential U.S. downgrade. While there's little hard evidence of large-scale U.S. capital flight into Switzerland or gold, uncertainty is fueling concern that the dollar-centered monetary order is weakening as a multipolar world emerges. Key risks ahead include potential U.S. regulatory moves on capital flows, further rating downgrades, and rising demand for safe haven assets like gold as geopolitical and financial pressures intensify. The speaker, Egon Von, the founder of Matterhorn Asset Management in Switzerland, in a crosstalk with Simon Hunt, is an independent strategist and consultant, warns that capital controls are coming to the U.S., with the dollar and financial system under attack. There are signs that confidence in the dollar is weakening. Investors are reacting to U.S. trade's tariff policies, rising debt, and political uncertainty, which in turn is leading to discussions about de-dollarization, diversification, and concern about the dollar's future role as the world's reserve currency. Figures like Robert Kiyosaki are warning of a looming central bank crisis. Egon and Simon suggest investing in gold, silver, and even Bitcoin, though often with caveats, as hedges against fiat collapse. Elevated inflation and weak growth plus geopolitical tensions are pushing institutional and private investors towards inflation hedges: gold, silver, real assets. Some analyses point out that usual safe assets, bonds, cash, may offer lower protection in this environment. Egon warns today's risks include banking crises, collapsing currencies, and rising social unrest, especially in the US. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I'm absolutely convinced that we will have capital. There will be capital controls in the US also. Dollar will be under attack. The financial system will be under attack. People want to transfer money out of dollars now are actually doing it now already. And we're seeing it. Americans reports about, especially the big banks in America, looking after wealthy families and individuals, that they're transferring a lot of money into Switzerland and also into gold, of course. There are not many places to flee to, are there?
No.
You got where you are in Uruguay.
Yeah.
Sorry, in Dubai, I mean. Uruguay is another one. From my point of view, I think Dubai is obviously fantastic now, but, it is next to the Strait of Hormuz. It can't be nearer than it is. It's so near. And, there has always throughout history and even throughout my lifetime been major conflicts in the Middle East. And, of course, then Dubai will be exposed also. For quite a while, part of my long-term forecast forecast. I mean, I clearly saw at the end of the 90s already, and this is why I decided that we need to protect ourselves. You never know when it's going to happen exactly, and that's why we said, this is going to come. The end of a monetary era is coming. That's absolutely clear in my mind. Of course, we will have ups and downs. We will have stock market bubbles. We will have crashes. But one thing I've learned that to forecast price is a mug's game, and it serves very little purpose.
Equities is even a bigger mug's game.
Yeah. And therefore, what I'm more interested is in risk and in direction of the economy and therefore of markets also. And to me, already from the end of the 90s, I decided that the risk is absolutely at a maximum already, and it's going to accelerate and get worse. And therefore, you needed protection. And protection, of course, my point of view was there's only one asset that has survived throughout history and maintained its value, and that's nature's money, which is gold. All other currencies, as we know, have gone to zero. It's so easy. If you want to protect your assets, your old nature's money, and you know that at least, as it has been the case for thousands of years, you maintain your purchasing power. You might not always make a lot of money, but now when we've entered an era where governments are accelerating the money printing because the deficits is also accelerating, and now it's such an easy decision. I think this is the easiest investment decision I've made in my life. So, we recommended up to 50% in gold 25 years ago. And now I would recommend 100%, or we recommend maybe 25, 30% in silver. I mean, it's obviously putting all your eggs in one basket. But, it's like Rockefeller said, put all your eggs in one basket and look after the basket. and
I can't remember the name of the old Italian family, but there was a story of how they retained their wealth going back centuries. When wars came, they left with their gold and their art. They had title to the lands, and when the wars ended, they came back and they retained their wealth.
Yes, I think we are in that era now. Of course, everybody isn't wealthy and has art. Or in Venezuela, let's say, 25 years ago, if they bought gold then, the dollar was about par with the Venezuelan bolivar. Now, of course, currency is destroyed, the country is destroyed. And if they bought just a little fraction of an ounce of gold in those days, they would have saved them later. And the same today. People don't need to buy kilos or tons of silver or gold. They can just buy a small ounce, because I see now, this is going to accelerate. The currencies have gone down by 99% in real terms, in gold terms, since 71. It's just 1% to go. But that 1% is 100% from now. And that we are going to experience in the next few years, in my view. How fast it goes, it doesn't matter, really. Protection is more important than, as I said, forecasting the timing. You were talking about cycles of markets going up for a while and then going down. Yes, you're obviously into shorter cycles. In my world, we don't worry about that. We worry about protecting the risk that you have today. And there are so many black swans hanging above us. US banking system, for example. Civil unrest in America. We haven't talked about America. We talk about Europe. It's the same in America. I see civil unrest in a major way in America. It's already there. People are helping themselves, for example, taking or stealing any goods they want in shops. It's not just in America, happening in the UK also. Just walking in, hundreds of people walking into a shop, filling the bag, and they can steal up to whatever it is, $1,000. That's not a crime. And we are already into lawless society, and America will be very high on that scale of lawlessness, in my view.
Egon and Simon argue we are nearing the end of the monetary era, with the dollar, euro, and pound all in a race to the bottom. Forecasting gold in collapsing currencies is meaningless, only weight matters. The U.S. banking and financial system, built on endless debt and self-financed deficits, cannot survive, and capital controls are likely both in Europe and the U.S. safe havens like Switzerland. Dubai may offer some protection, but risks are everywhere. The bigger picture is the clash between the old US-led unipolar order and the rising multipolar world. This transition could end in war, or in financial collapse triggering political and military breakdowns, likely around 2028. The only real safeguard, they stress, is holding physical gold and silver as protection rather than speculation. Now let's dive into the interview.
Trump is moving the reservists into Washington,
Yes.
Chicago, etc., etc.
You talk about capital controls in Europe. I see exactly the same in the US. From my point of view, it's a waste of time trying to forecast which currency reaches the bottom first. There's no...
It's a race to the bottom.
Yeah, exactly. And there's no prize for being the first. They'll all be there, the dollar, the euro, the pound, etc. As we said, they're already 99% on the way. So it's not far to go. But that will happen too. And that will be the end of this monetary era, the way that I look at the world. And that's why protection
I'm
is
in
more.
complete agreement. Technical Associate has the dollar index, the DXY, halving by the end of 2028.
Yeah.
DXY is now about 97. We have it at 50 in 2028. What does that mean to the gold price?
Yes, and you get to the point, Simon, and I've been saying that for quite a while, that, it serves no purpose to measure the gold price in collapsing currencies because it's meaningless. You might as well measure it in chickens or cows or something more useful. I mean, gold and silver should only be measured by weight, really. How many kilos or how many ounces do you own? That's the only thing that counts. You know that you will maintain purchasing power. And if it will be $1 billion for an ounce of gold in a few years' time or $1 million or whatever, it's totally irrelevant because what's the value of the dollar at the time? And that's why, as I said, I gave up forecasting the gold price many years ago because it is a mug's game, and to forecast it in something that is sinking by the day serves no purpose. I mean, I see the US banking system, it's not going to survive in its present form, and nor is the European one, of course. So keeping money in the bank, I wouldn't recommend anyone to hold any money except for short-term spending money. If you have gold or silver, it's total liquidity. You can sell a gram an ounce whenever you want, and there's always a price for it. There's always a price. Yes, you talk about capital controls in Europe, but when I see clearly that the same is going to happen in the US.
I agree completely.
So where do people go? That's what they ask, of course. They don't want to be in the EU. I mean, Switzerland always has been a better and a stronger economy than the rest of Europe. Of course, Switzerland is under pressure from the EU. I mean, to the EU net, comply with more of the laws and the rules of Switzerland is withstanding it. And of course, as Switzerland sees the EU collapsing, I sincerely hope and I believe that the Switzerland will definitely stay outside of the EU network. Whether Switzerland will be a bastion of safety and economic insurance in the future. I think it will because it's a sounder people and sounder economy than most countries. But otherwise, go to Dubai, as you have done. And of course, it works very well for a lot of people right now. Uruguay is another country. Again, you're in the middle of a poor South America. You have Brazil and Argentina next to you. And when the bad times hit there, I mean, they are going to go to the rich countries like Uruguay.
Sure, yeah.
So that's a risk too. So you have a risk today that unprecedented. Of course, maybe the safest is to go to Russia or to China. But for Westerners, that doesn't feel right. US debt's never going to be repaid. And when you have a financial system with the dollar as the reserve currency being in a country which is issuing massive amounts of federal debt on a daily basis, and there's no buyer of it except for the central bank itself. You're at the end. You know that if you both issue the debt and you buy your own debt, that is the
finished. Yeah.
Ultimate of all Ponzi schemes, isn't it?
Yeah. There's the question how all of this is going to end. Come back to where I started, that the real big picture is between the existing unilateral world that has operated for 80 odd years and the evolving multilateral world. It can only end in one of two ways. Either that the unilateral world, i.e. America, accepts that we are evolving into a multilateral world and therefore joins it. That's, under current conditions, is highly unlikely. Only other option is it's going to be war.
Isn't there a third option? America doesn't have to accept the dollar-based system at the reserve currency. It collapses. The financial system in the US collapses. The banking system collapses. Whatever desperate action they take with the whole Trump family now going into Bitcoin or cryptocurrencies and believe that that's going to be the savior of everything. That's not going to happen. In my view, cryptocurrencies are a bubble too, highly leveraged. And therefore, isn't there that third risk? I think there's a major risk that it's actually led by the financial system collapsing in the West, probably in the US first, but it could be France or the UK starting. It doesn't matter why the trigger comes. Isn't that a very high risk to this system also?
Yes, it is. But the multilateral world and the unilateral world is not just a financial one, it's a political one too. And that's why I think there are only the two big options. Now, you actually given the trigger as to how this war between the two types of world will end by saying, rightly so, that the US and the Western system, financial system, is going to collapse. And in that collapse, you will then have political collapse.
And military collapse.
Everything collapse. And on my cycle timing, that is around 2028. That's only, where are we now, 3 years away.
That's like tomorrow. It's so intellectually so exciting to be in this era now because, to discuss these matters and to try to not forecast exactly, but at least protect yourself and help investors around the world to protect themselves. And obviously with that comes helping family and friends and all of that. I see that as a major task of ours and for people who are privileged that we are, because whether it's 25 or 28 or 29, it doesn't really matter. The risk is here and now.
If the U.S. imposes capital controls, what options will remain for investors seeking to protect their assets? Could gold and silver alone provide enough protection in a scenario of systemic collapse, or should investors also diversify into other real assets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up. Because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. You know, I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks. That's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend-paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.